Welcome to the fascinating world of multi-bagger stocks, a realm where savvy investors find their path to financial freedom. This world is not just about numbers and charts, but about understanding potential growth and the power of smart investing. So, what exactly are these so-called multi-bagger stocks? Multi-bagger stocks are those rare gems in the stock market that have the potential to offer returns that are many times their cost. Picture this. A single share that you buy could multiply in value, not just doubling or tripling your investment, but potentially growing it by 4, 5, or even 10 times. Imagine the impact that could have on your financial future. These aren't just any stocks. They're the result of meticulous research, careful planning, and a dash of courage. They are the stocks of companies with impeccable business plans, valuable products or services, experienced management, and a robust team spirit. These companies are often at the forefront of technological advancements and are driven by a constant quest for innovation and improvement. But it's not all rosy. The journey to finding these multi-baggers isn't always a smooth ride. It's like navigating a ship through stormy seas. It requires a keen eye for detail, a deep understanding of the market, and a strong stomach to withstand the inevitable ups and downs. It's important to remember that investing in multi-bagger stocks is primarily driven by the desire for rapid growth. However, like all investments, they come with their own set of risks. The reliance on new ideas and technologies, market volatility, and competition are just a few of the challenges that these stocks may face. Now that we've introduced the concept of multi-baggers, let's dive deeper into the intricacies of this investment strategy. Let's explore the anatomy of a multi-bagger stock. Understand the risks and rewards, learn how to evaluate potential multi-baggers, and finally, unravel the tax implications of these high-growth investments. So what makes a stock a potential multi-bagger? Let's dissect this. First and foremost, the company behind the stock must have an impeccable business plan. This plan should clearly outline the company's goals and the strategies it will employ to achieve them. A well-structured business plan is a sign of a company that knows where it's heading. And that's a good indication for potential growth. Next, the company's products or services must be valuable. This doesn't necessarily mean they have to be the most expensive or luxurious, but rather they should offer something unique or superior that sets them apart from the competition. Whether it's a revolutionary new technology or a service that fills a gap in the market, the value proposition is key to driving demand and, consequently, the company's growth. The third ingredient in our multi-bagger recipe is experienced management. A company is only as good as the team leading it, and when that team has a proven track record of success, it can significantly boost investor confidence. Experienced management can steer the company through both calm and turbulent times, ensuring its survival and growth. But it doesn't stop there. A potential multi-bagger company doesn't rest on its laurels. It's constantly researching, innovating, and updating its offerings to stay ahead of the curve. This constant drive for improvement is what keeps the company relevant and competitive. And it's this relentless pursuit of excellence that can lead to exponential growth in the company's value. Finally, all these characteristics need to work together to drive rapid growth. A company with a solid business plan, valuable products, experienced management, and a commitment to constant improvement has the potential to grow rapidly, which is precisely what we're looking for in a multi-bagger stock. Understanding these traits can put you in a better position to identify potential multi-bagger stocks. And remember, the journey to financial freedom may be challenging, but with the right knowledge and a bit of patience, it can certainly be rewarding. Scene script. Like any investment, multi-bagger stocks come with their own set of risks and rewards. Indeed, the allure of multi-bagger stocks is strong. The possibility of your investment skyrocketing to 2, 3, or even 10 times its original value is enough to make anyone's heart race. But it's not all sunshine and rainbows in the world of multi-bagger stocks. There are risks involved, and they're worth considering. One of the biggest risks is the reliance on new ideas. Multi-bagger stocks are often tied to innovative companies that are attempting to break new ground in their fields. These companies are banking on the success of their unique ideas, products, or services. But innovation is a double-edged sword. While it has the potential to disrupt industries and generate massive profits, it can also fall flat. If the new idea doesn't pan out, the stock could plummet, leading to significant losses for investors. There's also the risk of volatility. Multi-bagger stocks can be incredibly volatile, with prices swinging wildly from one day to the next. This can be nerve-wracking for investors and can lead to impulsive decisions. In the face of such volatility, it's crucial to maintain a long-term perspective and resist the urge to sell off at the first sign of trouble. But let's not forget the potential rewards. If a company's innovative idea takes off, the sky's the limit. Stocks that were once trading for pennies can suddenly be worth hundreds of dollars. This is the allure of multi-bagger stocks, the chance to be part of a company's success story from the ground up. Furthermore, investing in multi-bagger stocks can also offer a sense of adventure. It's an opportunity to support new ideas, to back companies that are pushing the boundaries and shaping the future. And if these companies succeed, you'll be rewarded not just financially, but also with the knowledge that you played a part in their journey. As an investor, it's crucial to balance the potential rewards against the inherent risks in multi-bagger stocks. It's about making informed decisions, understanding the landscape, and always being prepared for the unexpected. Remember, investing in multi-bagger stocks isn't just about chasing returns. It's about believing in a vision, backing innovation, and being part of a larger story. Before jumping on the multi-bagger bandwagon, it's crucial to evaluate potential investments. Let's delve into the key parameters you should consider when assessing a company's performance. First and foremost, consider the reputation of the promoter. A strong and reputable promoter often indicates a well-managed company that is more likely to succeed. It's important to dig deep and find out about their past ventures, their successes and failures. This can provide you with a clearer picture of their potential to deliver on future promises. Next, evaluate the quality and demand potential of the product or service the company offers. A company with a high-quality product that caters to a growing market demand is more likely to become a multi-bagger. Look for innovative and unique products or services that can disrupt the market or create a niche of their own. Earnings per share, or EPS, is another crucial factor. It's a measure of a company's profitability and is calculated by dividing the company's net income with its total number of outstanding shares. A higher EPS often indicates a more profitable company, which could potentially translate into higher share prices in the future. The price-to-earnings ratio, or PE ratio, is a valuation ratio of a company's current share price compared to its per-share earnings. A high PE ratio could mean that a company's stock is overvalued, or that investors are expecting high growth rates in the future. However, a low PE ratio could indicate that the company's stock is a good value, or even that the company is in trouble. It's not a foolproof measure, but it's a good starting point. Lastly, consider a company's cash flow. It's a measure of a company's financial health. A positive cash flow indicates that a company is generating more cash than it is using, and vice versa. Companies with strong cash flows are often more resilient and flexible, which can be particularly beneficial in times of economic uncertainty. By considering these factors, you can make more informed decisions about your multi-bagger investments. And of course, it's important to understand the tax implications of your multi-bagger investments. Now, the taxation on multi-bagger stocks isn't a one-size-fits-all scenario. It varies and largely depends on your holding period. If you're the type who prefers short-term investments, brace yourself for a capital gains tax of 15%, plus a surcharge and cess. However, if you're more of a long-term investor, the tax scenario changes slightly. Long-term capital gains are taxed at 10 or 20%, plus surcharge and cess. But here's the silver lining. You get an exemption of one lock in the taxable amount. This distinction between short-term and long-term capital gains tax is crucial. It's more than just numbers and percentages. It's about strategy. It's about understanding how the duration of your investment can impact your tax outlay. Being aware of the tax implications can help you plan your investments in a more tax-efficient manner. So, as you chase those multi-bagger dreams, remember to keep the tax man in mind.